Global energy markets are facing a sharp escalation today as critical infrastructure comes under direct fire. This geopolitical shock is hitting the tape just as the S&P 500 tests its primary technical floor at the 200-day moving average support level. Today's market volatility is centered on a qualitative escalation in the Middle East. Nana and Rock are reporting that Israel has attacked Iran's South Pars gas field, the largest natural gas facility in the world. In response, Qatar Energy has declared force majeure on LNG contracts for Europe and Asia, a supply-side shock that could impact global energy flows for the next 5 years. The fallout from these supply shocks is already fracturing global markets. Eurodollar University reports that Brent is now trading at a $12 premium over WTI, signaling a significant period of market fragmentation. Meanwhile, the Fed's own projections are revealing a deepening GDP versus unemployment divergence. 42 Macro notes that while the FOMC has raised its growth estimates through 2028, they've also pushed their 2027 unemployment forecast higher, suggesting the structural costs of this energy shift are starting to mount. Macro Voices warns that global inflation is entering a third act, mirroring the sharp resurgence that followed the 1973 Yom Kippur War. While the historical pattern is familiar, the stakes are higher today because of extreme valuations. With a CAPE ratio of 40 now compared to just 18 during the 70s crash, the market is far more sensitive to an inflation spike than in previous cycles. Beyond this market vulnerability, a concrete threat is emerging in the supply chain. Potential blockages of sulfur and ammonia through the Strait of Hormuz are expected to trigger an agricultural contagion. There is typically a 6-month lead time before these fertilizer costs filter through to global food prices, providing a specific mechanism for the next stage of the inflation cycle. We Study Billionaires is highlighting a potential circular spending loop between AI leaders like NVIDIA, OpenAI, and Oracle. The argument is that these companies are essentially cycling revenue back and forth, creating a non-recurring earnings risk by inflating their books with one-off transactions. If this cycle isn't driven by sustainable demand, it suggests that current high valuation multiples are much harder to justify. Beyond the theoretical, we're seeing the first major wave of AI as labor replacement. 42 Macro reports that HSBC is considering cutting 20,000 jobs, or 10% of its workforce, as part of an efficiency-focused restructuring. On the revenue side, Meta provides a clear case of ad targeting remediation. We Study Billionaires notes that by using the technology to repair its core advertising systems, Meta has achieved tangible returns that move the narrative from speculative promise to actual bottom-line results. We're seeing sharp cracks in the housing market, where new home sales dropped over 17% in January. The hit was most severe in the Northeast, which saw a 44% crash, according to Eurodollar University. This weakness is colliding with rising rates. Nana identifies the 10-year yield hitting 4.3% as a critical resistance level for stocks. A breakout here would likely increase the pressure on already vulnerable equity valuations. Nana emphasizes that a sustained move above that 4.3% level creates a major headwind for equities. This pressure is building globally as well. The Bank of England just signaled a hawkish shift, with markets now bracing for a possible rate hike next month. This suggests that persistent energy costs are driving a much broader international push toward higher interest rates. In corporate signals, Micron is projecting more than $25 billion in capital spending for 2026. This level of investment suggests that long-term AI demand remains robust, even with recent volatility in share prices. At the same time, regulators at the NHTSA have upgraded their investigation into Tesla's full self-driving system, focusing specifically on visibility-related defects. On the regulatory front, the Fed is proposing a nearly 5% cut to capital requirements for major banks. Rock interprets this as a small-scale liquidity release for the sector. Shifting to mobility, Uber is committing $1.25 billion to a partnership with Rivian, aiming to put 50,000 robotaxis on the road by 2031. Nana identifies 6,500 on the S&P 500 as a firm technical floor, supported by JP Morgan caller positions. She notes that the incentive for short selling may be weakening at these levels. Looking further out, 42 Macro warns of a structural fiscal crisis window opening in the next 5 to 7 years, as Social Security retirement funds face insolvency. Finally, on the watch list, Bill Ackman suggested relisting path for Fannie and Freddie points toward a potential IPO in the fourth quarter of 2026. We're heading into tomorrow with energy shocks meeting heavily oversold technical conditions. Nana suggests that triple witching Friday could trigger significant short covering back towards 6,700. Keep a close watch on that 4.3% yield resistance. And for a full list of today's sources, check the video description.